Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Okay, so important to once more take a quick look at my longer term monthly charts. As I highlighted 18 weeks ago, there have been some very interesting actions taking place here on this monthly chart. So the market, since as far back as the lows seen in August 2024 till October 2025, built a sideways action. I had a breach on the upside in October last year and a second more serious breach in January this year, with February's bullish closing long white Mariposa pattern making the highest monthly close at the time since May 2024. What is more, we had a close then over the declining mauve 3-year moving average, which is currently 1139.5, and another now slightly higher in March. This mauve 3-year moving average had capped the rise back in November last year, and such a move over is important. Now, I previously cautioned about the possibility of a longer term false break on the upside, but with that close over the 3-year moving average and now a further move higher in March, pushing the bright red neckline, currently 1215.25, though I know still not closing over it, it nevertheless reduced, possibly removed that warning. However, though March has ended up, it also still ended up as an indecisive spinning top. Hence, I'm wondering if I should reinstate that warning. However, we must look at what will be next. This now maintains the bright red neckline above into the frame of the market on the action, along with the now starting to decline 5-year moving average, currently 1264.25. Back now to my daily charts, and you can clearly see that the same bright red neckline, a little above that, the current market at the moment, pierced but not as yet broken. So the recent action had been a small bull channel formed over February to early March, followed by prices shooting up through the bright red neckline, but even more swiftly turning back down. Though they were halted for a while by the extension of the same small blue channels, lower bull channels line, which is currently at 1188.5. Though it's now a dynamic resistance gradually moving higher as we speak. Instead, last week prices moved sideways throughout early to late March before dropping down last week to the green short medium moving average. An interesting one, that, currently at 1165.75, where prices swiftly rejected the move lower, rising to make a weekly high last week. Thus ended up with a weekly key reversal up. That was also this week seemingly swiftly rejected. We've not followed through on that one. Prices seem right now to be using the 2021 low at 1181 as an attractor and sort of spinning around it. We also left behind in mid-March what could be seen as either a double top or a V-top. In either situation, the market has not followed through lower with this pattern. This leaves us where we are now, capped overhead by the bright red neckline, and not too far above that, the dark blue middle sign. It's currently at 1233 of the December 24 to August 25 bullish Andrews pitchfork. And in between, the 50% Fibonacci line, the April 20 to August 24 move at 1222. Meanwhile, below we have the rising presence of the green short medium moving average. From these, it's obvious that something has got to give. And all we are doing now is just treading water until prices impact the overhead resistance or the rising moving average support, that green short medium moving average, impacts the market again. Chicago soybean meal. The market halted its autumn decline just under and then again a little later right on the long moving average, currently at 298.60. And down back then at the congestion at the 290.80, which was part and within the big old April to August 2020 congestion between 282 to 300. I said about this congestion zone 18 weeks ago, and I quote, "Is this enough to hold it? I'm not sure. It's enough to make the market think about holding." End of quote. The whole December 25 to January 26 move down left us with both an interesting bear channel and a descending, expanding wedge pattern. Prices broke up and out of both of these patterns, halting for a while at and around the significant dark blue trendline extension, currently 312 even of the July to September 21 descending triangle before moving higher. Now that move higher reached the primary, secondary, even the tertiary targets topside for the previously mentioned bear channel and descending expanding wedge patterns, before starting to stabilize over, specifically, the medium moving average, currently at 309.60. However, the topside has run into trouble, as it had done back in October and November last year. And that's with the combination of the 50% Fibonacci line of the May 24 to July 25 move at 326.20, and now the newer bright red middle time above, currently at 336.70 of the bright red late September 25 to mid-January 26 bullish shift pitchfork. We even had a weekly key reversal up last week, which has seen prices this week start to stabilize over the 50% Fibonacci line at 326.20, but which this past Tuesday saw the bright red middle time bat down the market, though admittedly not that far. This batting down action was something I spoke about 4 weeks ago when I said, and I quote, "Should prices turn back up, especially if we start closing over the 50% Fibonacci line, the next choice will be the bright red middle time. But a word of caution, you see the bright red middle time is now awfully close to the 2025 high at 333.5, and they together may be a stronger resistance than each individually. I suspect any reversal back upwards will very much depend on maintaining what we have seen since the beginning of this year, the low in early to mid-January. We have so far had rising lows, a very definitive bullish sign, and that depends on the market not pushing down below 308.90. End of quote. Indeed, what we have seen since the start of this year, bar one single aberration, is the market caught between the bright red lower time below, currently at 309.90, and the bright red middle time above, overhead. For now, I'll continue to watch this proxy bull channel, if you like, develop. This leads me to my final point, and a word of caution. This commentary would not be complete without my discussing a portion of my commentary which I have repeated for 150 weeks. So coming up now for 3 years is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we have been living in the shadow of this pattern ever since." End of quote. Now, I've also added ever since, and I quote again, there's only one thing you take away from any of my musings, let it have been those words. End of quote. For nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since. Chicago soybean oil. There is one pattern here that has defined the moves higher this year. It is the bright pink March to August 2025 bullish Andrews pitchfork. The bright pink upper time, currently at 72.34, capping the market in early March. Now, we also had what is now a failed pattern here affecting the market, and that's the bullish shift pitchfork for the March to December 25 move, specifically the upper time, which is currently below at 64.11, which did help the market stay up mid-March, but we are now far enough away that I'll likely retire this pattern next time. However, what is noteworthy is that despite the changeover gap last week, prices overall are having higher lows with a fairly static topside since early March. Thus, are we seeing the development of an ascending triangle or a halfway hesitation, or perhaps both? We are right now sitting on the support of the August 2023 high at 67.14 and pushing through the July 2008 high at 68.13 and all the way up to the congestion between 68.71 to 69.12, made up from the June 2008 high at 68.97 and the July 23 high at 69.12. This now raises the question, will prices halt at the early March high at 69.90 or even the June 21 high at 70.33? Or will they this time break higher into a fairly free area up to an earlier all-time high from 2008 up at 72.67 and make the March action into a hesitation part of a very large bullish halfway hesitation and an upside break of the ascending triangle idea, which is currently 65.61 to 70.15? That is the question. I suggest to continue to watch and see. Now, one final thought, and it's just to be cautious that we might have a weekly key reversal up happening today if we receive prices exceed 70.12 today. Watch out for that one. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.